All right. Hey, guys. We are live on the 107th episode of the Red Room. And today we have Rebecca and John from CMG Financial. I hope I said that wrong, right? It's not CMG. Sometimes I say CMG Mortgage, CMG Financial. I just get messed up sometimes. Anyway, but today we're going to talk about just the environment of mortgages. Just a little update on inventory. We popped down all the way down to like 23,200 actives. And I don't know if anybody's been watching, but if I were to guess that I would say Fidelity's opens are probably a little bit slower because we've jumped up about 1,500 units in inventory in about 4 weeks, which it's fall, so that's not anything crazy. I would bet that if you were to look at this same time last year in 2023 and 2024, you would see very similar spikes, if you will. So yeah, that's kind of what we're at. And I mean, we can probably jump in right now and ask what are mortgage starts looking like right now with Rebecca and John. Anything? What do you got?
Yeah. Well, I mean, I'll say this, because we've had a dip in interest rates, the mortgage applications have been stronger than ever. Okay. We've had the strongest mortgage application data come on in. And so that's been a really positive thing. Obviously having rates go down lower, even though you were just talking about inventory, if we talk about, like Dina, for instance, with opening up refinances, right, Dina? We've been having a good amount of refinances opening up. So John and I are working on refinances for, the regular people who live in their houses, and we're talking to them about getting a lower rate secured. Also with, I know all of us work with investors. We're doing a good amount of refinances for investors, also looking at refinancing their programs and getting that number down. And they're excited because then that's going to increase their cash flow. So that's a positive thing. But yeah, I mean, overall applications are up, whether it's for refinances and they're up a little bit for purchases because again, the rates are on their way down and everything. So yeah. Anything you want to add, John?
No, you hit it right on the head.
Okay. Yeah, absolutely.
So what if somebody's just coming off, they got stellar credit, what are kind of the going rates out there right now?
Yeah, kind of depends on program, occupancy type, all that. But it's like, say for a primary residence on a conventional loan right now, easily in the mid sixes, maybe could dip a little bit lower than that, just depending on circumstances. For a conventional loan, if we're looking at government loans like FHA, VA loans, we're looking in the low sixes, high fives for those individuals without really paying much in points whatsoever. So they've definitely made their way down for sure.
Yeah, the mid sixes. But I will say this: I'll make a comment, and this is getting a good amount of national news, if you will, as well. But the ARMs are back, okay? And we remember ARMs, for a long time. But you can get the ARMs in the fives, and you can get like John, like a 10-year ARM that you were just quoting. What was that rate you were just quoting on that ARM?
Yeah, I mean, we're looking at them for jumbos as well as conventional. Sometimes we have somebody locked in at 5.99 on a conventional 7.6 ARM right now. So yeah, the ARMs are definitely back. It's interesting. The pricing seems to kind of come in and out from day to day or week to week. Sometimes the 30-year fix is more attractive. Next week, the ARM's a little bit more attractive. So just kind of investor appetite, but we are definitely seeing a lot more ARMs, whereas we haven't touched ARMs in quite some time.
Yeah.
So you mentioned FHA and VA, the government loans being in the low sixes. So you want to touch on the fact that obviously the government shut down. Those are government loan programs. Are you seeing any delays in underwriting, closings, anything like that?
As of right now, no. We were just actually on a branch call before us speaking here now. There's depends on the FHA loan. Like for example, there's like Section 184, which is a very specific FHA product that is not being funded at this time. But standard FHA loans, for the most part, we're not seeing any issues. Now we just went on our call our senior underwriters were explaining, depending on how long this federal closing goes on for, we will start to see certain changes like higher reserve requirements for individual borrowers, like federal employees, and things like that. But as of right now, FHA and VA loans are still going through as normal. So we're seeing some disruptions, but not a terrible, not a lot. If this continues to go on for 2 weeks, 3 weeks, a month, we might start to see some changes.
Mm-hmm. Okay, so no, like if someone submitted today, we're still quoting. You're expecting like similar underwriting times. What's your normal underwriting time? 3 to 5 days on before you get like, hey, get me this document, this document, this document.
Yeah, probably like 48 hours.
Okay.
And even with the influx of volume that we're seeing, maybe 72 at the most, but I mean, pretty much 48 hours is good. I will say this though, for those properties that are affected by floodplains and in flood zones, the flood insurance has stopped in the government area. So if somebody needs flood insurance, we have to go to the private insurance area to be able to get flood insurance for those particular properties. So, that could be an issue, definitely. And as we know, flood insurance is more expensive. And so, from a cost perspective, that's definitely going to be, a costlier occurrence for some people. The other thing is apparently that in certain circumstances, if you had existing government flood insurance and you go change to private, there could be limitations to going back to it. And so again, it could be long-term that it costs you more money. So that's definitely an issue. I mean, fortunately, we don't have to deal with that a lot here, but we do, right? And I mean, Luke, you're up north. I mean, there's areas in the valley that got floodplains, but
yeah.
Right?
Well, absolutely. That's what I was actually just going to say is that we're coming across the stuff that we do up north right now. We're coming across the exact same thing with hazard, with obviously being in the forest. So it's been very, very difficult lately to get insurance on some of these properties. In fact, we've had to go pretty much private on all of the insurance that we've had to get for our flips, even for long-term and short-term properties as well. So it's been a real pain. We actually don't ask me how, because obviously we've got a bunch that are out in the forest, which I understand those ones more so, but we have some houses that are in town even that they are giving us a lot of problems, and we're having to jump through some pretty intense hoops just to get insurance on houses that are in town in Prescott. Because I mean, when you're in town in Prescott, you're not even close to the trees. I mean, you might be miles away at some points. And so, they've been cracking down on that quite a bit.
To be fair, hasn't the main road burned down like twice where the main saloons are?
No, the last time it burnt down was 1899. Come on. We got
you know how insurance companies are these days.
We got 125 years under our belt. We're good. Either that or maybe that means another one's coming.
Right.
But that also didn't start from a forest fire either, though. That was just, I think that was some drunkards at the bar, So
that's funny.
So with just some, I don't know, I just went brain dead for a second. But with some of these loans, I don't know what I was going to say. I just went brain dead. I had a question and it's gone. So.
All right. So I'll tell you what we're seeing as far as trends go. I mean, refis, I'd say month over month, we're about double. But opens on resale, we are definitely trending significantly behind. So we're seeing overall, the market is obviously very stable, and prices continue to stay pretty strong, but seller concessions are up. And another trend that we're seeing is that people aren't getting over asking price anymore very often. So
they're not getting what? You cut out a little
over
bit.
asking price.
Yeah, wouldn't that be nice?
So I think there's kind of, we're in a weird kind of limbo land because rates are getting, more affordable, but at the same time, sellers still aren't always that realistic about what their home is worth, right?
Yep.
So they really have to have motivation, and we are seeing a little bit of an uptick in cancellations as well.
Yeah.
Mhm.
Well, and I know, Chris, when you started, you talked about inventory being about 23,200. Several months ago, the high that we saw, kind of just in early summer, was somewhere around 26,000. That was like the highest that we got to, and the pullback in that is exactly what Dina just said about the sellers having an unrealistic expectation for what their values are worth, right? They're seeing that they can't get whatever this pie in the sky number is, so they're pulling them off the market, which has been really good. And then as they've started to see the interest rates go, there's always like that waiting period. When people start to see the interest rates go, they get all excited and they think, oh, let's just wait until they go down even lower, right? So, and I know we touched on this in the last RIA and just talked a little bit about this, but when we see the numbers shift, right, there's always an opportunity, and you always want to say, well, what's the opportunity, right? And Dina knows this because they've been so amazing doing all these refinances for us with the investors. But John, and I want John to touch on this, has done like 11 transactions with this and Dina's help with these refinances. With one of our Phoenix RIA investors, where they went and acquired properties in Sun City. So talk about that and what opportunity they found to go and buy super deep to get these properties. Tell them what went on with that.
Yeah, this specific client Rebecca's talking about was buying a lot of properties in the Sun City area. And as we know, Sun City's been a little bit of a bloodbath in terms of how many properties are out there on the market. And so he's taken this as an opportunity to go out and just pretty much call every single listing and just give them extremely low ball offers or disrespectful offers, as they say. And he's been getting, a large portion of them accepted. And it's great because he's been able to get it accepted, get the house turned around, and then refinanced. And this was somebody who was primarily a home flipper. That was his whole real estate investment strategy. And he basically turned it all around, and within, 6 months has acquired 12, 15 places for a rental portfolio for himself.
Yeah.
But he's been able to buy very deep.
Yeah. And so let's look at that. Okay. So what has he bought? So we're refinancing these things at a 75 LTV, right? And he's bought some of them at 60, 65 cents, 70 cents on the dollar, maybe
some 50 cents on the dollar.
Some 50 cents on the dollar, right? And some maybe like 72 cents or whatever it is, right? So when we're doing the refinance, Dina is so generously stroking back checks and saying money at closing, right? And so when you look at it, the guy's basically buying the properties for free. He's getting them for free, right? Mm-hmm. Then he's getting some money back. So then the ones that need a little bit of love, right? Then he's able to, do a little bit of fix-ups on them. And obviously, as a fix and flipper, he knows what he's doing. So he's doing that on a very low cost basis to do that. And, his whole strategy is that he just wants to hold them, because when he first started doing this, I said to John, I go, does this guy know what he's doing? Like, does he understand that? If he's a fix and flipper, does he understand he just can't throw these things back on the market and sell them? He's going to lose money perhaps, or what's his strategy? And he's like, oh no, I'm going to hold these for at least 10 years. Mm-hmm. And I said, okay, that's great. And he's getting just a tad bit of cash flow. So then he's getting the taxable benefits on it, because he looks at it and says, hey, I'm going to have some really nice write-offs and, depreciation and things like that. Which, as we know, with our big, beautiful bill, we could talk about. I know Dina and I were just talking about this the other day. You could do your bonus depreciation, cost segregation. And so, he could have some really great advantages on the tax side, with this. So he's got some nice free properties with some really amazing tax benefits, right?
Yeah, I mean, so in essence, he's burring an entire Sun City portfolio.
Exactly.
Yeah, that's exactly what he's done.
Which is pretty awesome. I mean, that's definitely, an example of taking advantage of a situation and making the best of it.
Right. Right.
Yeah. Where most of us would look at Sun City and be like, I'm not touching that. He figured
right, 100%.
Yeah, those $4,000 transfer fees add up really quickly.
Right.
It's like 60 grand right there. But hey, if it cash flows and it makes sense, right?
Right.
Yeah, you buy it deep enough.
Rebecca, I'd love for you guys to touch again upon what we were talking about before that, which is the timing of making a decision around do I or don't I? What are you guys seeing where people reach an inflection point of this is good enough, or I think the economy might get worse, or it's the wrong time of the year? Can you give us some indication of what you're seeing, of what's getting people off the fence and helping them make a decision around waiting to see what real interest rates might do versus just making a decision in general?
Yeah. I'll say this on the owner occupied side for people who want to buy a house to live in, for the people who are looking to live in a specific area, like maybe they need a school district for their kids. If you're looking for something that's really turnkey, like something like you make properties absolutely beautiful, right?
Thank you.
And so, yes. And so if, say one of your properties goes on the market and they're like, oh my gosh, this is in the right area. It's beautiful. I don't have to do anything to it. Once someone's been looking for a while, especially like the 6 to 12 month area, when the rates start to go down, then people are like, okay, I need to jump. And so the nice thing is for those people who, fortunately or unfortunately, however you look at it, have been in this market for 6 months to a year, once they see that perfect property that they love, they go, okay, I'm making an offer, because they've been through it. They understand what's going on. Those people who jump right in just because, interest rates, are perceivably low, they're going lower, they don't really know what the market has to bear. Those people can, that can take a little bit more time for them to figure out what's going on. But also if they have a really good agent who informs them where the market's going and everything, it says, you have 1 or 2 really nice properties to look at, out of 5. The other 3 are not so great. You've got 2, pick one of the 2. So, having a little bit less inventory, but knowing you've got a nicer home, it makes it, I think, a little easier for people to get off the fence, really.
Mm-hmm.
So, yeah.
And on the refinance side, as far as what's causing people to decide to refinance or not, of course, it just depends on their circumstances. Like I spoke to somebody today who, I was like, hey, are you guys comfortable? Can you make your payments? Or do you feel financially strapped in any way? And they're like, no, everything's great. We're fine. So when I looked at how much they could save, I was like, look, if you're fine right now, I think there could be more opportunity in the next couple months. Maybe let's hold off at this time, right? We always, look at a break-even period too, as to what's it going to cost versus what you're going to save, and dividing that into one and another. I have a different client who purchased a relatively expensive home with a high rate. They've got a really big payment. And with higher loan amounts, the rate change affects your payment in a greater capacity, right?
Right.
Then they might be saving like 0.6%, but that's going to save them like $580 a month. And they're like, wow, this payment's really high. I would love to save $580 a month. I don't care if they go down in the next 6 to 9 months from now. Like, let's get this done today. So it's just, it's kind of, if they're in a really good position, I'm talking to certain people where they're like, you know what, it'd be great to save $300, but I can wait another 3 months. It's not going to kill me. Others that kind of have a little bit of a pain point, or like, hey, it would really be nice to drop this payment, or they're deciding to pull the trigger, or if they need cash, like we're doing a refi, a cash out DSCR loan for a client who's got another project going on. She's like, hey, I would love to get $40,000 to help finish out this project, and then I'll finance that. So, she's pulling trigger on that. So it just kind of depends on their needs and the pain point.
And where are your guys' on that note, where are your guys' DSCR rates floating around now?
Yeah, good question. I mean, once again, I always preface this. Credit score, LTV, if you have a prepayment penalty or not, right? Because we know you can do no prepayment penalty, 5-year prepayment penalty. I was, on like no prepayment or like a 1-year prepay. You're still in like the low 7s, maybe 7, 7 1/8, 7 1/4, 7 3. With higher prepayment penalties, you can be down in the mid 6s. So you can get pretty low on it. I'm not a huge, going back to the market right now, I'm not a huge believer in long prepayment penalties right now, unless it's like something you need to make a deal work. But as we know, maybe that wasn't the best deal you bought in the first place, if that's the case. Right. But so generally, most people, if we're doing it, it's like maybe a 1-year prepay. Some people are doing 2. Because I think there'll be potential opportunity for them to refinance out of that in a year or so if rates do continue on this trend.
Yeah, because people they get really attached to the rate. You know, there's this whole like concept of rate in their head, and they're like, "Oh, I want the lowest rate." Well, we're like, wouldn't you want the opportunity in the next year to be able to refinance again, say in 6 months from now, so that we get you a lower rate instead of having repayment penalty? So when you explain all of that,
what's the opportunity
you
cost
know,
lost?
right? Then
That's a great way of looking at it.
yeah, most of them say, "Oh, you know what? Thank you for saying that. Let's hold off and let's not do it." But what's really neat is, you know, and I know we throw these numbers around. 40% of all the houses in the United States are paid off, and there's $38 trillion worth of equity in houses. And so, for so many of these like DSCR loans that we're doing for investors, there's a lot of equity people have in those houses, and they're looking at this right now as a big opportunity to take money out, like John said, and then go buy another deal or you know, go fix something up, or like you said, finish a project or whatever. So right now, like, to be an investor is a great time because there's so many different ways that you can take advantage of the current market and everything.
Mm-hmm.
Yeah.
So with the another thing with the government shutdown, like you're talking about future lower rates, like how do we adjust the rates? Like if we had a bad jobs report last Friday, if it would actually come out, and I'm sure it would have been bad because the private sector was bad, right? So that was our only gauge. I think Wednesday the private sector number came out and it was bad, so probably would have indicated that the Friday jobs report would have been bad as well.
Right.
But now we have no data. We're just kind of like,
we're waiting. Well, no, and it's interesting. So the last report we got was the ADP report right before the day before they shut down, and that was negative. That was like 35,000 jobs. So that was terrible. Even though that's one of the least important reports that we look at and everything. But definitely to your point, I mean, we're expecting that when they do come back out with it, when it actually does come out, that we're going to see that it's a negative number. Because, I mean, the labor market is definitely softening. We're seeing that in the construction and the manufacturing jobs, and that's really, really important. And so as the labor market just continues to go down, to your point, as we know, the 10-year is going to keep going down lower, and we're going to get lower interest rates as a result of that, you know. But, you know, the Federal Reserve is, you know, they're very restrictive. And I mean, Jerome Powell came out and he said anything from 0 to 50,000 job loss is still considered okay to me. Like he's like that's okay to him. That shouldn't be okay to anybody, because when you see that little job creation, all it does is show increased weakness in the labor markets, which then naturally decreases the 10-year. And with the 30-year and the 10-year being as close together, and the mortgage spreads being closer together, that also causes downward pressure on interest. So yeah, so Chris, to your point, like, what a bummer, what a terrible time for us not to get a jobs report, because had we gotten it out, who knows where the 10-year would be right now? You know, it would likely be lower, to your point. Yeah.
It could have a 3 in front of it, possibly.
Yeah, absolutely.
Nice.
Absolutely. Yeah, absolutely.
And then people kind of forget as the 10-year kind of compresses, then your yield spread compresses because there's less opportunity or less risk, like you said, of refinancing a year down the road, because that's what mortgage lenders hate, right? They don't want to put out money and get refinanced a year down the road. I mean, it's good for loan officers and CMG Financial to get multiple, like a loan now and a loan in a year, but for a long servicer that needs like 3 to 4 years to actually make money on that loan,
right?
They don't want that. So, you know, as the 10-year comes down, there's less risk of a refinance, so that yield spread starts to compress as well.
Right. No, absolutely. And that's why I think a lot of people too are loving the ARM thing, because I think people are like, you know what, a 7-year or 10-year ARM, that's a long time, right? Nobody keeps their loans 30 years, right? Yeah. And so if you say, hey, let's get in the 5s now and lock you in for 7 or 10 years, you're like, you know what, great, I'm done with it for the moment. I don't have to worry about it. I feel really good about it. Because we don't want to churn loans. John and I are not in the loan churning business. You know, that's not what we want to do. Because like you said, we're mindful of those loans being paid off. And, we rather wait, like John just said, and counsel someone and say, hey, let's wait another couple, 2-3 months. Because look at it, right? We're in the first week of October. So much is going to change between now and the end of the year.
Yeah. So let's just touch on those ARMs. And I haven't done an ARM in I don't know how long. Are there points where you can grab an ARM right now and then they can adjust down and you can lock them? Like I haven't read an ARM document in, I don't know, 10 years probably, maybe 20.
Yeah. I mean, like when we're doing the ARMs, we're not really paying much points for those ARMs, right?
No, but
Yeah.
are you asking like if you can like say that again, Chris?
So like most ARMs, right? They adjust. They usually have an initial and then they have they adjust every year, right?
Right.
But some of them had like locking mechanisms in them at some point for a fee or a small fee, or are they still written like that? Or like I said, last time I had an ARM was probably like 20 years ago. I don't know.
Yeah.
There was
Yeah, no, they're no longer written like that, which is really good. Yeah, it's really good. So you basically get locked into that rate. And then what happens is you qualify, at that rate. And it's pretty simple.
Yeah, depending on the ARM term. Yeah, if it's 7 years or above, then you're going to qualify at the note rate. If it's less than that, then generally you're going to qualify at a little bit of a higher point above that note rate. But yeah, a 7.6 ARM, for those that just don't understand what that is, would be like you're locked for 7 years. After 7 years, it can adjust once every 6 months based on an index and a margin.
Right.
But for most people, the idea is they want to get out of that product by year 7 or before.
Gotcha. Yeah,
and when people are buying like those new homes and the rates are lower, are those fixed forever or just for a period of time? Because I know there's a lot of incentives on the, lenders that are offering pretty low rates right now for new construction.
Yeah. So kind of both, Gina. That's a great question. So some of them are a 30-year product that's bought down permanently for the life of the loan. Okay. Those are probably a little bit higher. And then you've got like the temporary 2-1 rate buy downs where those are only for the first 2 years, then the goes back up 1 point second year, and then the third year it goes back up to what it would have been and everything. So kind of both. You can do the temporary and the permanent with that, but the builders are paying a lot of money to do that.
What sort of prepayment penalties would someone find on an ARM? Because if they're leveraging their cash flow by using something like that with the foresight to maybe refinance should something better come along on a 30-year fixed, what sort of prepayment penalty should they expect if there is ones baked into that?
None.
Yeah, no, really none. I mean, no different than if we're talking about a DSCR and applying a prepayment penalty. But no, it's like a standard ARM. Like if I'm doing an ARM for an owner-occupied person, there's no prepayment penalty as part of that.
Interesting.
Yeah,
I don't think you can do a prepay penalty on an owner-occ, can you?
No. I always joke with borrowers about that. I'm like, even if I wanted to give you one of these things, I can't.
I got to take my renewal hours still yet this year, but I was like, I'm pretty sure you can't do a prepay on an owner-occ. You can do a prepay on an investment like a DSCR, but you can't do it on an owner-occ.
Yeah. But for an ARM for an investment property, there is still no prepayment penalty.
You could have one. Yeah, you could have one for an investment. Yes.
Yeah, that's what I was. I'm sorry, that's what I was specifically asking for. I didn't clarify that though.
Oh yeah, for investment, yes.
Yeah. And I don't know if this is good for loan officers. Just a little highlight from the commissioner event last week. I'm sure it's good for loan officers. If the Department of Real Estate is doing it, I'm sure the Department of Financial Institutions is doing it. You shouldn't be doing your continuing education in Taiwan unless you actually have plane tickets.
That was interesting. When the commissioner was talking about what's next on the licensing front, I was like, wow.
Well, it's interesting is, as you guys know, I teach continuing education. And I was thinking, wow, I had never thought of that before. So I thought that was pretty funny. We do them in person.
Yes, we do them all the time.
We do them in person all the time. Yep, the old school way. Yeah. We can't do it, but yeah.
For Chris, it might actually apply. I mean, it could have been in Ireland or the BVI or Florida. In your case, it might count.
I just thought it was funny. She's like, if I see your IP address in your Taiwan, and you're saying you're doing your 24 real estate education hours, I'm going to ask for a plane ticket. I was like,
Yeah.
okay.
Yeah.
Yeah, there was a lot of interesting points that she made at the Phoenix RIA last month, and we're also going to get an update this month at the RIA from Brian Locker with Fowler St. Clair on some of his takeaways. So that'll be fun. If you guys missed last month, definitely hit up any one of us. We were all there. The commissioner had a lot of interesting things to say for folks who are licensed and those who are not. And we've got another great event coming up in 2 weeks.
Yeah, so let's talk about that. Like, hey, 2 weeks from today, we have the Phoenix RIA Expo. It's obviously the third Tuesday of the month. We're going to be talking about AI, how you can apply that in real estate, and maybe Rebecca will get us some cool tools on how she can apply it with mortgages. I don't know. And Rebecca and John are sponsors at the Phoenix RIA, but yeah, we'll be at Orange Street Country Club 2 weeks from today for our expo, which generally has 150-ish, 160-ish people at, and we'll maybe get Luke to come out. He, we see Luke show up. That's a guest appearance.
Absolutely.
Yep. You better be wearing like a sleeveless tuck shirt.
Yeah, there's no way. I'm not wearing sleeves. That doesn't happen.
I'd be disappointed if you do at this point.
But Rebecca and John, thanks for jumping on. Give us all your insight. If you've watched this video, obviously follow, subscribe, look up Tracy, Luke, Rebecca, John, Dina. Follow us on Instagram, YouTube, anywhere you can find us all. But thanks for joining us again.
Thank you, guys.
Bye, guys.
Bye.
Take care.